Hey everybody, Smart Silver Stacker here. So inflation is way up, and yet today we're seeing gold and silver way down. So that's not really what you would expect, right? I mean, aren't gold and silver supposed to be inflation hedges at this point of the game with inflation at 9.1% year over year, according to the official numbers? That's the worst CPI print that we've had since 1981. We got that yesterday. Gold and silver, they should be taking off, right? Well, a lot of it has to do with perceptions. Investors seem to believe that the dollar is the right safe haven to be in, not gold and silver, which is strange until you reflect upon the global scenario because the Fed, they've been raising rates, albeit at a relatively slow pace. It seems like they've been talking about fighting inflation for a while now, and yet the federal funds rate is at 1.5%. So it's not like they've been raising rates too aggressively, despite what the media might tell you. But the rest of the world, they've been raising rates even slower. And so as a result, the US dollar, compared to many of these fiat currencies around the world, it's looking attractive. One, it's a world reserve currency, so it's a good place to be if you are uncertain about the future and if there's a risk of a major recession and if there's a war going on. And so all of that happens to be the case at the moment. But also, if you're invested in these foreign currencies, or if you live in these nations and you're an investor and you have those foreign currencies, and the yield on the dollar is higher than those currencies, that may cause you to sell your currency for dollars and move into the space where you can get a little bit more yield. Because even though the yield on the dollar is laughably low in the face of 9.1% inflation, or 9.1% CPI, because we all know real inflation is likely much higher than 9.1%. But you move into the currency where you can get a yield. And that is one thing that the dollar has going for it over gold and silver, I guess, is that it has a yield. Although when you have something like a 3% yield on a 10-year treasury, I don't know the exact number, I think it's lower than that actually, but and that's the kind of yield you have on your dollar holdings, and you have 9.1% inflation, you'd think, well, that doesn't seem to be a very good deal for those holding U.S. dollar denominated debts. And yet that's what's happening. That's what's happening around the world. The U.S. dollar index is strengthening. Individuals, investors are moving into dollars as a safe haven. And as a result, we are seeing the paper price of gold and silver fall. And we're seeing that trend continue. Now, how far are they going to fall? I don't know. I mean, I don't have a crystal ball. Timing markets is very difficult, but I guess we could see some kind of a major spike down in the precious metals. The only way I really see that happening at the moment is if we get some kind of black swan event that causes a pan sell-off across the board and it just causes everything to sell off in unison. But even if that happens, it will just be the paper price. I mean, even today, silver's down in the $18 range, and if you want to get physical silver, like what I'm holding in my hand here, even if you get maybe the cheapest form of silver you can find, some recycled generic kilo bar like this one from OPM, which typically would have the lowest premium to spot of any bullion product, with the exception of maybe a 1,000-ounce bar. If you want to buy one of those, or a 10-ounce bar, or a 1-ounce round, or anything, the best price you're going to find on that is maybe $22 right now. I mean, maybe you can get down into the $21 range, but that's about it. That's about as low as physical silver is at the moment. So, even though we've seen the paper price dip into the $18 territory, the real price of actual physical metal is still above $20. And even if you want to sell your silver right now, I would expect you could easily get more than the spot price, given the premiums and, where they're at. Now, one of the reasons that I think that this downturn in the price of precious metals cannot last very long is the latest commitment of traders data. And here I'll put that chart up on the screen, and you can see here this measures every week the positions of COMEX traders. The long positions are the bars above that center line, and then the short positions, the commercial short positions, are the red lines below that center line. So you can see here the latest reading is very extreme. I mean, the longs have almost disappeared from the chart. And what that's telling us is that there's not that many people left to sell. And then also, look how small the short positions have gotten. I mean, the weeks before, that was an extreme reading, but now very few shorts left from the commercial side. And that means that, the commercials, the smart money, they don't want to short silver at these levels. And you got to keep in mind, this is data from last week. We haven't even gotten the data from this week yet. And so likely the readings after today's sell-off are going to be even more extreme. And essentially, there's just no one left to sell in the paper market. So I think we are at least approaching a bottom here. Although, like I said, there could be some kind of a major pan sell-off. We could see silver and gold spike down. But the other reason that this extended sell-off in the precious metals is not going to last that much longer is, we are approaching a terminal phase of this whole experiment. I mean, the Fed, they're raising rates now, albeit pretty slowly. And, after the inflation numbers that we got yesterday, there's been this talk of the Fed raising a whole 100 basis points at the next FOMC meeting. And, if you speak in the common vernacular, not, talking in terms of basis points, 100 basis points is 1%, so that's them getting hyper aggressive. I think they like to say 100 basis points because it sounds like they're doing more than raising it 1%. But, even if they do that, that's the, worst case scenario or the most hawkish scenario. You're raising rates by 1% in the face of 9.1% inflation. So, what's that supposed to do? It's not going to get inflation under control. Although, it might be the thing that kicks off that major pan sell-off because markets are so fragile right now. Everybody is so indebted. And, I talk about the US dollar being stronger than these other foreign currencies, these other fiat currencies that it's measured against. And, the US, we have a tremendous debt load, but some of these countries have an even worse debt load. Look at Japan. I mean, they have a more than 200% debt to GDP ratio. So the dollar, I mean, it's just the healthiest patient in a terminal ward at this point. And the Fed, maybe they can raise another 1%. Maybe they can do that twice. Maybe they can do that 2 FOMC meetings in a row. I don't know what the limit is going to be, but they're going to reach the limit pretty soon. And it's going to be before they get to the level of interest rates that they would actually need to fight inflation because something is going to break. Back in 2019, they tried this quantitative tightening. They tried raising rates to get this Fed balance sheet normalized. And before, the pandemic and all of that disaster from 2020, before any of that happened, the repo market started to break. Elements of the financial market started to break, and the Fed was forced to stop quantitative tightening. They were forced to stop raising rates, and we're going to reach a similar point here in the very near future. The IMF managing director just warned yesterday, I think it was, that we are facing a massive debt crisis because the dollar strengthening the way it has. It is putting tremendous pressure on a lot of these developing nations that have dollar-denominated debts. So as their currencies are devalued against the U.S. dollar, their ability to pay their dollar-denominated debts is being diminished significantly. And so, that's one possible trigger we could see. If they start a wave of debt defaults, that could be a trigger to cause this, house of cards to start falling apart. It could also just be the fact that the Fed, they're not going to be able to raise interest rates significantly for any long period of time because of the massive debt loads here domestically. We got $30 trillion in debt. So every time they raise that federal funds rate 1%, that's about another $300 billion in debt service that the U.S. national government is forced to pay. That's not an instantaneous thing because this debt, has to be rolled over, but most of the national debt is very short-term debt. So it doesn't take long for these interest rate hikes to catch up with the federal budget. Also, so far so good as far as jobs and the economy goes. It seems like, on the surface, despite the fact that you're paying $5 for diesel fuel and more than $4 for a gallon of gas, a lot of people still have their jobs. At least that's the mainstream narrative. Although I think there's more than meets the eye there as well. I think the strong job numbers, they just look at jobs like all jobs are equal. But, we've got a lot of service sector employees in this country. We've got a lot of waitresses and waiters and bank tellers, and nothing wrong with those jobs if you had those. I've actually had some of those jobs. They're not the kind of jobs that you see in a healthy, strong economy. You would see more manufacturing, you would see more high-paying jobs, and that's not the sort of thing we're seeing in the job reports. That trend is going to change. I don't think that these strong job numbers are going to persist in the face of rising interest rates, in the face of economic contraction. And when people start to lose their jobs, and they're still facing, 9.1% or higher inflation, and that's really going to put a tremendous amount of pressure on American households when their incomes are depleted and yet their cost of living remains high. And when that starts to happen, that is when we are going to see a tremendous amount of political pressure placed on the Fed to pivot and to begin easing to help relieve this recession that we are headed into and possibly are already in. We're going to get those July numbers for Q2 GDP here pretty soon, and I think that's going to reveal that we're already in a recession. But when that really begins to manifest itself and people start to feel it, I don't think that the Fed is going to prioritize fighting inflation over relieving extreme economic pain among American voters. And, if you think the Fed isn't a political entity, you've got another thing coming. I mean, for one thing, they're appointed by the president. So, if Powell just decides to continue fighting inflation despite whatever the current administration wants, he'll just get replaced. And that's how it works. And, we've got former Federal Reserve Chairwoman Janet Yellen. I mean, she's in the administration. So, these folks are all in bed with one another. They're all on the same team, even among the different parties. Powell was appointed by the previous president. So, that's something to keep in mind as well. But the end game, for silver and gold, that's what we're stacking for. So, these pullbacks, they don't tend to worry me too much. What worries me is the fact that we're $30 trillion in debt and we're facing a massive recession and inflation is beginning to get out of control, and why individuals continue to feel that the dollar is a safe haven in view of the situation with inflation and what's going on. It kind of mystifies me, but I am glad that that's the case, because as a net buyer, as a net accumulator of physical silver, the fact that I can buy this stuff cheaper today than I could last week, I view as a very positive thing, because nothing fundamentally has changed. The dollar is eventually going to be toast. There's a lot of pressure on it internationally. There's a lot of these moves towards de-dollarization from all of the friends we're making, around the world. Ultimately, the Fed's quest to fight inflation is going to be in vain. And so that is why I am still stacking silver. That is why these pullbacks in the paper price, I mean, they don't bother me even a little bit. And I know that a lot of you feel the same way from the comments that I read, and it's reassuring to know that at least some people understand what is going on with the financial system. Because I got to tell you, when we face a monetary crisis or a debt crisis or a dollar crisis, however this financial meltdown manifests itself in the relatively near future, those of us holding precious metals, we're going to be the ones who are not panicking. We're going to be the ones who understand that we have wealth that has stood the test of time. And I think that a lot of people are going to be in for a very rude awakening. And people who are putting their faith in paper fiat currencies, they're going to have a bad time. So let me know what you think in the comments down below. Are you worried about this sell-off? Or are you just buying more like me? Thank you all very much for watching. Don't forget to like, comment, and subscribe, and I'll catch you next time. Smart Silver Stacker, out.